Good morning, everyone. I want to welcome again our good friend Keith Murphy with Essex Mortgage. Keith, how are you doing this morning? Great.
I'm doing fantastic, Kelly. Thank you for asking. How are you doing?
I'm doing very well.
How are you doing?
I'm very, very well. I was telling you earlier, I started working out a couple of times a week, so I'm sleeping like a baby, and it's definitely making a difference in my overall attitude and physical well-being every day. So we had decided that we were going to give the folks a little bit of information about FHA loans, what they are, the mechanics of how they work, and what's different about them. And so Keith, being the mortgage expert that you are, let's just jump right in with, what does FHA stand for?
So that's an interesting opening question, because I find that most clients that contact me about FHA, for some reason, everybody thinks it stands for first-time homebuyer loan. And that would be an FHB. But FHA actually stands for Federal Housing Authority. And all it really means is that the Department of Housing and Urban Development, not Fannie Mae, not Freddie Mac, but the Department of Housing and Urban Development is insuring these transactions. So Federal Housing Authority, that's what it stands for. And You do not need to be a first-time homebuyer to get an FHA loan. In fact, in some unique cases, you can have more than one FHA loan at a time simultaneously.
So really?
For everyone and anyone. And it's really all about, the borrower and their credit and income and employment picture. And there's just some things that make the gateway or access to home ownership easier. They're just easier loans to qualify for when it comes to FHA versus conventional.
Okay, all right, great. And then we had talked about, or let's go into some of the specifics of the FHA loan. What is the minimum down payment and how does that work?
You bet. So the minimum down payment is 3.5%. However, it should be known that we have a program for FHA where you can do as little as zero down. I'm not particularly fond of the program, but it's available, so people should be aware that they can do as little as zero down. But I'll stick with the 3.5% for today. One of the unique features of it is that 3.5% minimum down payment can be gifted. It could be from your boss. If your boss was very generous, it doesn't have to necessarily be a blood relative, but someone who's you have a close relationship with. Or you could take a loan against a retirement plan. I didn't say withdrawal, which you could do, but I'm not a fan of that either. But you could take a small loan against your retirement plan and repay yourself interest-free, essentially, because any interest charged on a retirement plan benefit loan, that interest that's accrued is paid back to yourself. So in essence, it's a free loan. But yeah, 3.5% is generally the down payment. Now, I won't leave people wondering, well, why aren't you talking about the zero down? That's probably a whole another conversation, because the guidelines for the zero down FHA and the terms and conditions are a little bit different than the regular FHA. So with the regular FHA and the 3.5% down, I think it'd probably be important to lead into why go FHA versus why not use a conventional loan as a first-time home buyer. So this is a key difference. As a first-time home buyer, you could actually get a conventional loan with 3% down versus the FHA 3.5%. So right away, someone might say, well, why would I want to do FHA's 3.5% when I could do conventional with 3%? Again, it comes back to the key differences between conventional and FHA. It's credit score.
Okay.
And then debt to income drivers have lower credit scores. They'll be impacted immensely on the interest rate and the private mortgage insurance on a conventional mortgage, almost making it not beneficial. And when I say lower credit score, Fannie Mae and Freddie Mac, especially right now, things have tightened up because of the COVID and its impact on people's employment and our economy. So the Department of Housing and Urban Development has tightened things up a little bit on FHA. Conventionals tightened things up even more so. So anybody who's got a score under 680, right out of the gate, I already know FHA is going to be a better loan. Why is that? Because FHA, the Department of Housing and Urban Development, they do not have loan-level pricing adjustments. And the viewers are going to say, well, what's a loan-level price adjustment? It's basically an insurance hit that the government institutes on all loans. And the loan-level price adjustments on conventional loans are much higher for lower credit score borrowers than on FHA. So I'll just give like an example. Today, if you had a 640 credit score and you wanted to do an FHA loan, you could purchase a home with 3.5% down and get a 30-year fixed under 3%. Okay. Wow. If you were doing a conventional loan and you're a first-time home buyer and you had a 740 credit score or above, you could get a 30-year fixed 3% down at 3%. But if your FICO score was 680, that rate might be 3.3 to 3.5. If your FICO was 660, it might be 3.75. And if you were at a 640, you'd be over 4%, 4.25 to 4.5%, because the government's loan level price adjustments for those lower scores, the rate up.
It seems crazy that we're talking about 4%. Like, oh my gosh, you know, it's all relative. I get it. But these rates that we're talking about right now are just so, they're just so incredibly awesome. I mean, it's really a fantastic time.
Yes, it is. And I'm glad you brought that up as just a side note, or to piggyback on what you said. It's fascinating to me, 26 years of originating loans, meeting with clients, showing them their options. There's one constant, and it doesn't matter, you know, I was originating loans at 12% when the rates were 12, or 10%, or 7, or 6, or 5, or 4, or 3, or now we're in the 2s. The same thing seems to, what's the word I'm looking for? It seems to come up, which is 2.8. That sounds a little high. I think I'm going to wait until it gets a little bit lower. And they said the same thing when what's the rate today? It's 4.5. Gosh, that seems a little high. I think I'm going to wait till it gets a little bit lower. Like at 3%, we're at such a historical low, and it is a historical low. Like we've never ever seen this before in our industry, in our banking system, where you could go borrow dollars and the rate's under 3%. That's free money, because inflation, by way of comparison, your grocery bill and average, your car insurance, etc., everything in life, the expense is going up over 3% year over year. Government says it's not, but if you keep a personal budget like I do, you go back in time year over year and see how much you're spending on groceries and healthcare and gasoline and car insurance, etc. And so you're able to borrow money for free right now. Pretty crazy. Essentially,
yes. And I mean, when people look at, we're talking about these being historical all-time lows, because it goes back to the 1910s and 20s when rates were this low. But even at that time, people did not necessarily borrow money to buy their property. From the bank, they might buy their property from the person that owned it before, and they would owe them a mortgage. You know, they would have a private mortgage with that person, or they would just pay cash. And if you didn't pay cash for what you used, I mean, this whole credit buying things on credit really evolved in the 1900s, early 1900s, and came, you know, to big fruition after World War II. So it's, you know, if we look at economically, you know, where we are now, it's a great time to buy, to borrow, to be able to move your life forward. And like you always say, fix your housing expense. Yes. Everything else is going up, and your housing expense can just go up fractionally with your taxes and your insurance.
Correct. And if you did a pie chart on all your expenses and what percentage of your expenses go to transportation or healthcare or groceries or rent. The largest slice is housing. So if you can cap that and fix it forever, your salary will grow over time and you'll start getting ahead of the game. And I always preach that. You're right, that is the number one reason to go from being a renter to a homeowner. There's many other benefits, but for me, and when I advise clients, that is the number one reason you need to cap that largest percentage of your paycheck outgo and make sure it doesn't continue to grow as rents do.
Yes.
And interesting also, Kelly, going back to what you said about the 1920s and paying cash, interestingly, it was during the Great Depression that the federal government, the Department of Housing and Urban Development, instituted FHA because banks stopped lending. You remember
Right.
You weren't there, I wasn't there, but banks stopped lending and banks were failing because people were making a run on the banks in a panic and withdrawing all their money. So they weren't lending money out to anybody. They were just trying to keep what they had. So the federal government came up with FHA to encourage the banks to lend and basically said, we're going to indemnify you from loss. So if somebody misses payment or something is not repaid, it's not going to hit your balance sheet. We're going to take it. And that's where FHA was born, was during the Great Depression.
Okay.
Thought you might like that little factoid.
I do. Yeah, I love history. So speaking of that, what is the mortgage? There is a mortgage insurance premium that the borrower pays, and that helps with that insurance that the FHA or that HUD backs these loans. So can you kind of explain how that works?
Absolutely. So every FHA loan, even if you were getting FHA and doing 50% down, you're going to have mortgage insurance on that FHA loan. So you wouldn't do an FHA if you were doing 20% down or more. It just would not make sense.
Right.
But there's a key difference between conventional loans where you're not doing 20% down on any property. There is some form of mortgage insurance to protect the lender, the investor, from a potential loss because they're exposed. There's not enough equity in the property should something go south, and life does happen, right? So whether it's a job loss or a divorce or a health issue, there's life events that cause loans to go into default. So you have to have mortgage insurance. And then specifically to your question on FHA, they collect an upfront premium that is equal to 1.75% of the base loan amount. So if you took your down payment, let's say it's for easy math, $100,000 home, you're going to have to put down $3,500 minimum down payment. That's 3.5% of 100,000.
Right.
So your base loan amount, see how awake I am here, is 96,500. That's your base loan amount. Now, HUD charges 1.75% upfront mortgage insurance premium. It gets stacked on top of the base loan amount to give you a total loan amount. So they're basically allowing you to finance a majority of in their words, the majority of the MI cost up front to lower the monthly premium that they're going to charge. So the way the monthly premium works, it's actually an annual premium divided by 12. They take the base loan amount, multiply it by 0.85%, divide that number by 12, and there's your monthly PMI, or MIP is actually what it's called. It's MIP because it's not private, it's the government.
Right.
And then
Mortgage
conventional PMI because, yes. And PMI, obviously you see I like facts and figures and stats, but PMI is private mortgage insurance, and on an FHA loan it's MIP because it's not private, it's insured by the government. The key difference though, what somebody should really zero in on right now, if they're listening, is on an FHA loan, the premium's low regardless of your FICO score. There's no adjustments to the premium based on FICO. Where on conventional, there's a loan level price adjustment to the MI, not just the rate, but the MI as well. On an FHA loan, the MIP, I almost messed up. The MIP is a lifetime event.
Okay.
It never goes away. While
For the
you're in
life
that
of the
loan,
loan.
you're going to continue to make that monthly payment. Yes. And that, now, it can go away if you build some equity and get your credit scores up. We refinance our clients all the time, get them into the house with FHA, and then get them out of FHA after they've raised their credit and built some equity in the home into conventional. And sometimes we'll even do it into conventional with PMI because they don't have the 20% equity spread. So the point is, you don't have to wait 3, 5, 8, 10 years to refinance out of these loans. It's either that you refinance it or you hit lotto and you pay your loan off. But that is a recent development, because from the Great Depression and through years ago, that PMI on an FHA loan would drop off. And I'm bringing this up because a lot of clients challenge me and say, wait a minute, I heard that like after you make a certain number of payments on FHA, the PMI goes away. And I'm like, yeah, that used to be the case. But then the accountants at the Department of Housing and Urban Development and our Federal Reserve and Congress said, wait a minute, I've got a stat here I need to look at. 46% of all first-time home buyers buy a home through FHA. That's a fact. And if we're at historically low rates, okay,
right,
who's going to refinance in the future to get out an FHA loan at 2.875 just to get rid of the MIP when rates go back to 5, 6, 7%? They're not.
no,
So the government's smart and said, let's change the rules. That way it's going to stay in that loan forever and pay PMI or MIP forever. So we make it our mission to stick close to the client and get rid of the loan as soon as we can and get into conventional for that very reason.
right,
It doesn't mean FHA is bad. You
right,
can get into the home with a low credit score and have that great rate and a low base PMI or MIP compared to PMI. It is a great way, a gateway into home ownership. But
absolutely.
yeah, you definitely want to get back out of it as soon as we can.
And I think that, if I'm not mistaken, that change in the rule took place after we had the economic downturn of 2008, 9, 10, where we had so many FHA loans that did go into foreclosure and that we needed to do short sales on. And so that FHA insurance really got used. I mean, there were a lot of banks that the only way that they could really justify doing that short sale was because they knew that they had that FHA insurance on the backside of things to kind of help shrink their loss.
Okay, what they were basically saying is we've depleted so much of the mortgage insurance premium reserve that we risk losing FHA entirely. Like the system's going to go bankrupt. And the only way that we're going to be able to save FHA is premiums, and then make sure that the premiums don't go away for the American people. We're doing this to protect this great product that helped us in the Great Depression and is now helping us in the Great Recession, and we need it for the future. So Congress said, absolutely, we're supportive of this, let's do it. Well, here's the facts though. If you look at how much they had in the General Reserve Fund,
yes,
which by the way, FHA is the most profitable endowment program ever instituted by our federal government. It's a moneymaker. And so if you look at how much was in the reserve before the Great Recession, and then how much it was depleted, and then look at, that's when they said we're going to run out. If you look at what was in there, there was enough money in that fund to pay off every single FHA loan in America 3 times over. So you tell me, was it really in jeopardy? Was it really going to fail? Did they really have to change these rules? I think not. I think they did because on their side of the fence, it's good business.
So interest rate you've talked about is keyed off of, or is just, it is what it is for an FHA loan on any given day and at any different time of the day. It fluctuates just like every other loan rate does. But the difference being with an FHA loan, no matter what your credit score is, within reason, I think, what is it, minimum of 620 on FHA?
It depends on the lender you ask that question to. Ours is now 640. It used to be 620.
Okay.
As if we get to high balance loans, which are over the 510, 400 limit in LA and Orange County, which is different, you know, where most of your client base is, the cap is 442, 750. But where I'm at in Orange County, the loan goes over the 510, 400 because that's our conforming limit on FHA. then the FICO score is 680.
Oh,
But
okay.
there is some small adjustments to the FHA rate, not the MIP, but the FHA rate for the lower FICOs, but it's nominal. It's like a half point to fee. So you, instead of getting 2.875, you might get 3.1 on an FHA loan. It's not a big difference.
No, not a big difference at all. So so lower credit scores, you can get a loan. And then the down payment is super affordable. And then as far as the costs, I think the cost for like an appraisal, for example, on an FHA loan is comparable to the cost of an appraisal on a conventional, if I'm not mistaken. Runs right around $550. Yeah, okay.
Yep.
And then other benefits would be that, again, just the low amount of money that you can get in with, and that can be a gift funds, which I know it can be gift funds from any other source, as well as, you know, like you said, a loan from your retirement. And then are there any other benefits that we haven't talked about already?
Absolutely. There's many, but I'll just key on a couple of ones that apply to most people. One is the debt to income ratios for housing to gross income, and the combined debt to income ratios, which is your housing plus all other debt. Those are much higher than conventional loans. So the average borrower, if their budget allows it, can buy more home on an FHA program than they can on a conventional program. And there's more underwriting leniency on an FHA loan than there is on the conventional. For instance, you know, you could be a student in nursing, as an example, and you graduated from nursing school and you just started your job 30 days ago. Well, conventional wants to see that you've been working for 2 years before you can get that loan. But FHA, as an example, more lenient, will allow us to use the schooling, get a copy of the diploma as part of your job history. And as long as you were in school for 2 years and now you're starting your new nursing job, you can qualify today, right when you get your first pay stub. So one of the other key differences that often gets forgotten is that FHA loans are assumable. And that's important in this low rate environment, because if you go to sell your property in 2, 3, 4, I don't know when rates are going to go up. I just know they're going to go up at some point. They have to. But imagine there's a neighborhood and there's 3 homes for sale on the block, and all of them have to be financed at the prevailing interest rate of, say, 5%. But you could sell your home and offer an assumption on the balance of that mortgage at 2.875. Of course, the buyer's going to have to come to see somebody like me to get a second mortgage to cover the delta between what they owe and what the price of the home is. But if you could finance a majority of the home at 2.8 when rates are back to 5, 6, 7%, carrot to dangle on the for sale sign in your front yard and attract a lot of buyers, which means you could probably get a premium for your house when compared apples to others.
And so with that in mind, once the FHA loan is in place, I've purchased the home, I have an FHA loan in place. 5 years down the road, I want to sell my home. I want to offer that low interest rate with only 25 years remaining on it to the new buyer. And then they can come in and FHA will allow, they will subordinate to a new, so there has to be a subordination agreement, correct? So that FHA stays in position number 1. And they will allow a new second, as long as it doesn't exceed probably a certain threshold in debt to income ratio.
Yeah, it's the same qualifications on the assumption. So you're right. It's an important point. The loan's not, it's basically taken over. So you have, in your example, 25 years to go instead of 30 at 2.875. And then the second mortgage would be the delta between the balance of that loan and the sales price less 3.5%. So the combined loan to value between that assumptive first and the new second exceed 96.5% of the sales price or value of the home.
Yeah, that's really fantastic. So that definitely is going to be a huge selling point, I think.
Yeah, let's talk one other key benefit here. The waiting periods for major credit derogatories, which, again, life happens. So
Right.
whether it's a bankruptcy or you had a previous short sale or foreclosure, the time you have to wait before you can re-enter the market are set higher for for conventional loans. The bar is set higher for conventional loans. Back into the market on an FHA loan, within a year after bankruptcy, within 3 years after a foreclosure. We need to make sure, and we're going to do our due diligence and make sure that whatever the life event was, it's not a recurring event. It's not a pattern of behavior, if you will.
Right.
But if we can isolate what the problem was, it's since been cured, it's not likely to happen again, and the borrower has proven the ability to now repay things on time, you're back in the market again on FHA quite quickly, compared to conventional, you may have to wait upwards of 7 years.
Nice.
So it comes back to the beginning. A lot of people think, oh, well, that'd be great, but it's only for first-time home buyers. No, it's for everyone. You could use it your second, your third, your 10th time buying a house.
Yes. And it is intended to be for your primary residence, correct?
It has to be your primary residence.
Okay.
Yeah. Now,
so
you can use it to acquire as your primary residence investment property. So you can buy a duplex, a triplex, a 4-unit property. Yeah, and we can use the income off the units that you're not going to be living in to purchase that property, and the minimum down payment is still 3.5%. So it's a great way for young folks who don't, have a family yet and don't mind having, tenants as neighbors. It's a great wealth building tool, because if you were to compare it to the conventional, there's a couple little niches that I won't get into on this call here today, but on the conventional, basically you need 25% down on units to acquire the property, whereas on FHA, again, if it's your primary, you get in with 3.5%.
Great. And so the other thing is that if I'm not mistaken, the amount that you can borrow goes up if you're buying more than one unit. So if you're buying a duplex, it goes up a little bit, the loan amount.
Yes.
Yeah,
in
the
fact,
maximum loan amount.
Let me quote you a few numbers here real quick, Kelly.
Okay.
In Riverside and in San Bernardino County, again, if it's a single family residence or condo, your max limit's $442,750. We established that. But on a 2-unit, a duplex, it's $566,800.
Okay.
3 units is $685,100, and on a 4-unit property, it's $851,450.
Right.
So the loan limits, you're right, are higher for units than they are for single units.
The reason that you stopped at 4 is because that's where it stops. It caps at 4 units. Right?
For all residential programs, it stops at 4 units. When you go above that, now you're talking commercial property. 4 units or less is residential financing, and over is commercial property.
Right. Well, Keith, as always, you're just a font of wisdom and information, and I appreciate you taking the time for us this morning. We will get back to another session and probably dive into those 0% down programs more intensely, so that we can be, again, just be more, bring more education and information to the public, to our clients. And I just want to thank you again for taking time out of your busy weekend. And I know everybody's jumping on you to get their refis done and get their purchases done. So I'll let you go. And I wish you a good, as stress-free day as possible.
Thank you, Kelly. And I'm going to catch you off guard here in my goodbye.
Okay.
And share some, what I think is exciting news.
Okay.
And I'm learning as I go. But as you know, I teach home buying classes every month. I have so for about 13, 15 years or so.
Yes.
And it's one of my passions. It's a great class, a great platform. But with the COVID and the shelter in place and wearing masks, it's just not it's just not conducive to these classes. So they've been put on hold since March, and next Tuesday night, we are going to start doing these classes virtually through Zoom. So if anybody wants to register for next week's class or for any future class, you go to freehomebuyingclass.com. So there's no spaces, www.freehomebuyingclass.com. You register. The class is for free. You'll get a Zoom link the day of the class. You'll get materials emailed to you in the form of a PDF. So you'll get workbooks, worksheets, materials, education. And so if people like this little spot we did on FHA, they're going to learn a whole lot more by logging on to freehomebuyingclass.com.
Awesome. Thank you so much. We'll make sure that we put the link in this, and probably put an ad out on Facebook to be able to help promote that. I know I've been to your class before and I learned so much myself. So I appreciate that you do this, and I know that it's great that this free information, I always tell people there are great, well-qualified, well-educated people who are willing to give you information for free so that you don't have to be, trying to fumble around and do your own research all on your own.
Oh, thank you. Yeah, amen. And I wish we had more time so I could go down the punch list here of everything that we cover in that class, but just to sort of entice people to think about registering for any of our classes, which are free. The goal is to educate, empower people. It's not to win them over and encourage them to do business with us. It's just about spreading this knowledge, which you're right, is lacking. And, the rent inflation is one of the biggies. I don't ever hear about mortgage companies or banks explaining to clients how inflation eats away at their ability to get ahead in life, or the power of compounding, the rule of 72, how not just savings, but reduction of debt compounds over time at 2.875%. Kelly, do you know what percentage of the very first payment that you make on your mortgage, what percentage of it is going to principal, debt reduction, wealth building? What percentage is going to principal versus interest to the bank? Do you know that number?
I don't. I'm going to throw out a wild guess and say maybe 4%.
43% of the first of the principal and interest portion of the payment. 43% of the first payment goes to principal, and every single payment after that compounds in the borrower's favor, and it just gets more and more and more. Now, 4% is the right number when rates are normal at 7.5 to 7.8.
Oh my gosh.
Closer to like 95% of your payments going to the bank's pocket in the form of interest, and a small sliver, 4 or 5%, is going to principal. But right now, and that's a unique opportunity that people will learn about at my class, 40, 43, 47, depending upon your rate, you could buy your rate down to 2.5 and get it to 47%, which is almost half of the payments going to debt reduction. You're building equity very, very quick right now with these low rates.
Yes.
Not only that, the interest costs are low, right? So just little things like that. I could go on for another hour of all the talking points we're going to cover in the class, but I guess you got to register for the class to learn more. Starting at 6:30, but they have to register at freehomebuyingclass.com to get on the list, and we'll email out the link a few hours before class starts, so it'll be at the top of their inbox. They just click the link and they're in the room, and they sit back. Everybody's going to be muted except for me. Mm-hmm. And we're gonna go deep, and that's the worst case, is they're gonna walk away with more knowledge than they had about home buying and loan programs and math than they did coming into it. That's the worst thing that's going to happen by registering.
And then the good news is that you're going to be doing these on an ongoing basis. So if people want to come back and repeat the class because they missed information the first time around, didn't, get the notes, or, for some people, it's like, even though you've got the written program, hearing it is, and you know, and seeing it spelled out is much more, that they're better, they're a visual learner is what I'm saying. So you are going to be continuing to have these classes on a monthly basis or bi-weekly? Or
Not
has that been?
100% sure on the
Okay.
on the sequencing, but for
Okay.
sure, minimum once a month, for sure.
Okay, great.
And yeah,
Terrific.
they can come back and watch it as many times as they want.
So I'm going to wrap up here. Thank you again. Have a great weekend and a great Saturday. I know it'll be a long, busy one for you, but you know what? We're doing the best we can to serve the public right now. And I totally believe in you and your ethics, and that your team's going to be able to serve as many people as possible. Thank you.
Thank you, Kelly, and we believe in you as well. You're a great agent. Thanks for all that you do. Thanks for having me on this call and for getting some information out to your fan base there.